The Conference Board's index of leading economic indicators rose in June for a third consecutive month. The increase reinforces the argument that the worst of the recession is over, and that adds to the pressure on Federal Reserve Chairman Ben Bernanke. He's expected to offer some exit strategies to end the government's rescue efforts when he testifies before Congress tomorrow. Our economics editor, Michael McKee, is here with a preview. And Mike, twice yearly appearances, always a focus of attention, but more so this time.
Yeah, because when the Fed was meeting the last couple of times, there was nothing for them to do. The rates were going to stay low. They're still going to stay low for quite some time, not going to be raising them. But people want to know what's going to happen. They want to make sure that people are prepared for when they do start raising rates. Remember, back in 1994, the Fed, coming out of recession, raised rates rapidly and essentially bankrupted some bond dealers. They want to make sure that doesn't happen. And also, if they can convince the bond market that they have things under control, they have a plan, they hope that interest rates, market rates, won't go up in the meantime.
Okay, so how do they do the last?
Well, the Fed, here's the problem. The Fed poured a lot of money into the economy to try to get us out of this recession. They doubled their balance sheet to more than $2 trillion. Excess reserves, the amount of money that banks have to keep on hand that they can't lend out, rose to almost $900 billion at one point. It's just under 800 right now. If that money went into the economy in the form of bank loans, we'd get a huge amount of inflation. So the Fed's going to say they'll pay interest on those reserves. They'll pay banks to keep the money just sitting there. They already are paying them a little bit, but they're going to raise that amount as they raise the Fed funds rate. At the same time, they'll cut their balance sheet. Part of that will happen as some of these emergency lending programs end. And then they're also going to sell off some of the securities they own and maybe do some reverse repos, lend some of those securities out in exchange for cash.
And pay interest just to keep it there so they don't flood the market with it again, correct?
Exactly.
Well, the big question is this going to work?
That's the big question. There are concerns because this has been tried overseas, but it's never been done in practice here in the United States. There were a couple of months where this was in force earlier, and there were leaks. Some of the banks, some of the people who get Fed money have reserves like the GSEs, Fannie Mae and Freddie Mac. They don't get the interest on reserves, so they lend it out. That causes problems. The other big problem is arbitrage. If I'm a bank and I have money sitting there, why not buy treasuries paying 2% than, say, Fed interest on reserves at 1%, or treasuries paying 4% rather than 2%? So they got to figure out how to deal with that as well. It's going to be an interesting experiment.
How tough a sales job is Mr. Bernanke going to have starting tomorrow?
Well, it's going to be very tough because some people are never satisfied. A lot of people are saying, hey, this is premature. We're not out of the woods. This is going to go on for a long time. Rates are going to stay low. You don't have to worry about it. Others are going to say, inflation's coming right away. You got to get on the ball. You got to have this plan ready to go right now. Some say he'll probably just steer a middle course. He'll say, we have the plans. We are confident we can execute them, but don't worry, we're not going to raise rates for a long time. There's some thought that he might even say at least for the end of the year.
And that Fed's chairman's testimony getting underway tomorrow at 10 a.m. New York time. We'll, of course, have live coverage here on Bloomberg Television. Michael, thanks.